Kick things off. Welcome back, everyone. This is the Kingscrowd Podcast. I'm joined by Scott Kitun. I'm your host, Brian Belley from Kingscrowd. Each week, we're breaking down different online private market trends, just anything related to investment, capital raising in the online private markets and alternatives. This week, a couple different topics we want to talk about. We will kick things off just diving in with a little bit of a deeper analysis on the first half of the year 2026 Investment Crowdfunding Report. Going to transition from that and some of the trends there to what we're seeing in the public markets. And we'll talk about, some of these venture funds like Robinhood Venture Fund. We'll bring that into the discussion and harken back to our Boxabl IPO discussion as well. Just wanted to share a fun little story there. So Scott, I'm going to share my screen. I'll pull this up. We released 2 weeks ago the first half of the year 2026 Investment Crowdfunding Report. Now, people around the industry who are looking at it in, say, May of this year, it was the lowest number ever. Not really. A little bit of hype. It was one of the lowest Mays since 2020. But a lot of people were like, hey, retail investment's gone away. They're not investing in this market. We'd look at the numbers for H1. It told a little bit of a different story. So Reg CF did see a pullback. But overall, if you're looking at retail investment volume, both Reg CF and Reg A, it was a pullback from 2025 for the first 6 months, which 2025 was an all-time high since 2014, 2016, when kind of Reg A started. So we saw a pullback, but still higher than 2023 and 2024 for the first half of the year. A few other trends, if we're just trying to take a look at a few different things, is both Reg CF and Reg A saw a pullback. So there wasn't necessarily one of those that was really driving it. But overall, again, May was one of the weaker Mays since going back to 2020. And if we take a look, you can see the dip for May. All these charts, by the way, available for free. You can just head over, sign up for the newsletter. You get a lot of analysis like this. But I guess, Scott, I'll toss it over to you. A lot of these charts, right, we're showing a bit of a trend, a bit of a pullback in 2026 compared to 25. Still so far outperforming 23 and 24. So, what do you make of this in terms of just investment volume, any other trends? I know we've talked about a lot of this in past podcasts, but I'll toss it over to you.
Yeah, I'm always looking for outliers. So my question is, and I can't remember dates, 2025, beginning of the year, that's the big push to all-time high. Did that include was it Newsmax, or what was the deal that got Reg A?
Yeah, I'm pretty sure Newsmax. That's a good call out. Let me see if we didn't have it in this article, but I believe that
part of a $300 million IPO, something like that, which is a huge chunk of change relative to the total.
Yep, March 2025 was Newsmax.
Bam.
And so they had 2 rounds. We broke it into 2 rounds. They raised 75 million. So we showed 11 million here and 64 million in the other one.
So if you're smarter than I am, if you were to go back to that chart and weighted average, how does that in your head? We're obviously not going to visualize it right here unless you can. Like, what does that do to that chart? Does it make it look more like this year, and it's less of a massive incline, or how do you?
So so 300 million. Let's just use round numbers. 300 million was Reg A plus in the first 6 months of 2025. So if 75 million of that coming up on a quarter, right? It's almost 25% of the total volume attributed to one raise. 2026 was not that different. So granted, it was 75 million less, which would be the difference of a Newsmax raise, but Reg A plus tends to stand out with those big one-off raises. So if we actually go down and first off, like DealMaker, absolutely dominating the Reg A plus space for, the online private markets. They raised, 34 million in the first half. So excuse me, 140
I just want to double click on that, Brian, because that's an important thing. We've talked about this before. That their model, I'm not saying that they're the ultimate winners here or that there needs to be winners. Their model is the only one relative to the way things are currently designed that is sustainable, because in that model, they don't have to do 75 raises a year. They literally could do 12, 15, 20, so long as like 2 of them are above 25 million or 30 million, they're probably good. Then they do a couple of 5, 7s, and if they land a Newsmaxy for 75, like it's a fucking huge year. And if not, whatever. And this is sort of something that this is not just about, like, I go platform by platform looking for outliers. I do it at Gigastar. I do it I mean, I do it really everywhere. That's pretty much my investment thesis is I look for outliers. It's really all there is. And I just notice this frequently that like there's certain platforms that you can look at and realize really quickly that they're designed so that like they're almost dependent on outliers to happen, and it happens so infrequently that the business really struggles, and then there's like waiting for the next whale to float in. And that's where I get a little bit worried about some of the smaller ones that you show here. When I look at DealMaker and platforms, again, not just crowdfunding, any kind of investment or really any business in general that doesn't necessarily rely or look for outliers. They just have like smaller volume, higher allocation. And then if they land an outlier, which they truly have a higher propensity to do so because of their consistency, it makes them look really good. So I guess I look at this and I'd go, if I removed Newsmax, which to me is an outlier, it is an outlier that will happen, every couple of years. I don't expect it to happen, every year or even multiple times a year. If I remove that outlier, to me, it looks like 23, 24, 25, 26 are steadily going up, but have kind of hit their plateau, as opposed to this like rocket ship growth 24, 25, rocket ship drop 25, 26. It looks to me like more of a kind of a candlestick, steady, but like limited. I guess that's what my eyes tell me when I think of the potential of an outlier at that 25% of the capital.
You're hitting on a key trend. I'll show two charts. The one I was looking for is this one, which showed the top 5 raises for Reg CF, Reg A+. Yep. So you can see even for 2026, Rad Intel raised 64 million. EnergyX, another big raiser. I'll just open up the chart down here. EnergyX, 62 million, 27 million from Meso. So like those 1, 2, 3, 4, 5, those 5 raises were the majority of the Reg A+ capital raised in H1. Which is similar. And when you take a look at some of the volume, the number of new raises coming to market has been drastically dropping off a cliff, right? So the number of new issuers who are launching peaked in 2023. There were like 742 Reg CFs. Bring it to date, we're almost 50% down, where there's 388.
I'm not zoomed in on my screen here, but I'm assuming that the green stock is Reg A+.
Green is Reg A+, that is correct.
Yeah. Does that look, it looks... Yeah, plus or minus every
20.
year. It looks the same.
33, 27, 20. Yep.
It's consistent. You know what it is? It's 6 to 12 companies per year that are in a financial situation, and they met with someone from, either their side or from DealMaker or me or somebody else who says, hey, you actually are in a position to do a mini IPO, and they buy in on the concept of a mini IPO as opposed to other traditional funding mechanisms. And it's proof that what we've been working on for 10 years works, and it works exactly how it's supposed to work. And it is consistent, but it is small. It's large relative to the number of deals that, bring in that amount of money, but like it's consistent. It's 25 to 30% of all capital deals end up being Reg A pluses. It tends to be 6 to 12 companies, just like we just said. And if you look at the CF part, that's the glaring part. It not only is a massive drop in the number of issuers, but it's also a massive decline in the amount of dollars raised per campaign.
Yeah. Well, so that I'll just correct
one
minor
thing. That's
thing.
the opposite, right? They're more money per campaign, less campaigns.
Yeah, the average amount has actually gone up, which is the interesting thing. So we're seeing this concentration of capital where there's half as many issuers on Reg CF, but the ones who are coming tend to be more mature. They tend to be at least doing better raising on average. Now, again, we're talking about averages. So the reason could just be that those other 350 companies that made up the 700 in 2023 and before, half of them were junk, half of them weren't serious, right? They weren't actually using this as part of a real capital raising strategy. They heard about crowdfunding as this new thing during COVID. They said, hey, there's money available. Let's go see if we can get some from investors. And they realized, oh, this is actually a lot more work than I thought. It's not just you post the page and people invest. So what you're seeing is a divergence where the number of launches has been going down. The amount of capital, the investment volume in terms of millions of dollars has actually been steady. So because of that, the average has actually gone up per raise who's still here. However, there's fewer raises. And if there's one of the things we know in the industry from tracking all these hundreds of active offerings at any point in time, a lot of new investors that come into the market come in because of a single issuer. They know, right, Scott, founder of this company, or Joe, founder of this company, and they might learn about investment crowdfunding and that you can even invest in private companies online as a non-accredited investor or credited because of these companies. So if there's just fewer issuers coming to market, there's lower awareness. Plus, let's pivot the conversation a little bit to the public markets, but there's all this competition we've been talking about with public-private funds, right? Like the Robinhood Ventures Fund with USVC on the AngelList side. Yep. I saw Robinhood recently announced that they're launching RV2 already, so a second Robinhood Ventures Fund. They're starting the IPO roadshow. However, Scott, you brought up that I'm sorry for all these ads. An article here was just saying how, there's been news around key Robinhood shareholders who are selling big stakes. And if you look at, some of the analysts out there rating Robinhood Ventures 1 as a strong sell. So, what do you make of this just in terms of the broader picture, in terms of retail capital trying to get into some of these private investments?
I don't have a problem with Robinhood doing a venture fund 2 or 3 or 5. And particularly if they diversify them. The first one was like, hey, here's the biggest 20 names you know. And if you click on it, you can go on Robinhood and actually click on their Robinhood Ventures Fund 2 or Fund 1. And you can see the portfolio when it's all the names you know. It's like OpenAI and Stripe are up at the top. 1% is SpaceX. They got in late. The next couple funds, I would hope, would be a little bit more focused, defense targeted, this, that, and the other thing. And probably a little bit earlier, or they're going to buy secondaries from people at maybe a slightly earlier stage, so there's more upside. Inherently, we've talked about this a ton. I still think this is the way to go. If I'm a retail investor and I want to get exposure to private, like early stage private deals, this is still safer than anything else. And if you have enough money that you can, get into a fund like direct, like whether it's Tribe or Sequoia or something, well, Sequoia is pretty elite, but like if you can get into, a good fund, a fund that has actual, like real access, and you have the risk appetite for that, you should do that, because that is by far the highest potential reward, but it is the highest risk. You will probably not see your capital back. Even good funds, 21 vintage is like a 10% write down, if not more. So there's absolutely a chance of not getting your money back at all. There's a strong chance of getting it back, maybe plus a little, if at all, 10 years later. So again, risk reward. This public-private stuff allows people to get in and get out in real time. What you are getting, though, is the thing that I think is worth noting, because we talk all the time about why this is important and how people should get access, and there's no reason that rich people get this and that and this and that. I'm very glad that we have gotten to the point now where all these things are available, and I think they should continue to be. But the rich guy question, like why do rich only get to play in early private markets and poor don't, is really not the question. It's that the rich guy has either the appetite of risk or the ability to take the risk that the poor guy cannot, the retail guy cannot. And the rich guy can do it with a check size that's substantial enough that it makes it life-changing if they're right. And if they're wrong, it's nil. Whereas the poor guy has to put in, or the retail guy, not saying they're all poor, but like compare it to institutional. The retail guy has to put in a number that they can absorb the loss on, and that number tends to be small enough that the big win does not meaningfully change their life. And that's sort of the issue here is more about what risk you have for what you want to invest in and what your expectations are. The challenge as you scroll through this site right now, the challenge that you're going to see is that while you get all this diversification, the stages vary. And most of them are later, Series C, Series D, Series E, Series Double D, Series M, whatever the hell was just announced for one of the recent companies, or Ramp or whoever it was. And so the issue is that you're not going to see the massive growth that you're attributing mentally to when you hear about early stage private startup investing. You're going to see, if you're lucky, 1 to 3x, maybe over 10 years if the stock and the company is really, really good, which I'll get to that in a second. You could see much more, but you're not going to see more than a 1 to 3x pop at IPO. And honestly, you're probably going to go backwards. And if you look at SpaceX, which we've talked about a bunch, and I am bullish on Elon and SpaceX, just not at the price that they're at. And you and I look at the stock every day and smile until it gets down to 85, and then maybe we'll be lucky enough that it crashes out to 50. I'll buy all that shit. But like, it is a bet that has a higher than likely chance as a retail investor that your stock is going to go public at a slightly raised price from what you bought at in this fund, but will regress. And then it may, if it is a great company, it will work its way back up again. But the way you're thinking about it as a private retail private investor is like, oh man, I'm getting into early startups that are going to IPO. And that's not kind of like is accurate. So what I think about this, and I think about the Robinhood's funds, and I think a USVC is the biggest issue. And I would argue that this is an issue we have dealt with in the crowdfunding / retail private space, is a lack of sophistication, a lack of clarity, a lack of narrative and communication. We spend a lot of time building up startups in the future and innovation and all these things. And then the reality is like it's a more sophisticated than that. It's building a portfolio based on limited information that you believe has to exist as a product or company, service, whatever, that you believe when you look at the financials looks like a strong company. The stewardship is strong and not all over the place. And there's no key man risk. Like if, the one person freaks out, the whole thing goes down, which is one of the issues with like OpenAI. Like what the hell's with Sam? And same thing with Dario and Claude. Like it's these guys are a little bit, enigmatic. As a retail investor, we don't necessarily, Kingscrowd certainly helps, we don't have the tools necessarily to look at every single one of these companies. So to summarize a lot in a sentence though, it is important and it is awesome we have access. I will, once these couple of funds kind of shake out and I understand what NAV looks like, the total value of the fund, assets under management relative to a public market valuation, once I see enough trading to know what the hell it means, I will be an investor in these things. Absolutely. I think it's a great way to like put a little bit of your money into something that could pop. But also I would just say, I would not invest in these if you would not want to hold those stocks 10 years from now. If I look at that fund and the biggest 3, 4, 5 allocations in it are not companies that I think in 10 years are still going to be kicking ass and important, major, like they are the next replacement of the Fortune 500. If you don't believe that, then don't invest. That would be my takeaway on this. I love it.
Yeah.
But just make sure you know when you're investing in what you're investing in, which is, I think, a lot of times there's a misalignment when retail buys this private fund. It goes, it's liquid. And it's like, it is, but it doesn't move. It only goes backwards until they're set free. And then, then the markets can take their chance.
I think that's my biggest, it's not a gripe necessarily, but one of the biggest things with these marketing pages, it's completely focused on the company names. It tells you nothing about what valuations or prices these were acquired for. So you are purely investing in Databricks, OpenAI. You're saying, I want to have them, but I don't care what price necessarily. Now we can assume that Robinhood hopefully negotiated or got those through, some process that made sense and was more of a fair value. But that's like one of the biggest differences.
By the way, Brian, they clarify that. They do say, like, they don't, like, when you can go into, when you buy into the stock, you can see like allocations and serieses and all the things. So like, and you can look at that. You just don't necessarily know what that means because the market is kind of silly. Like it's all overvalued together. So like, I know when they got, I mean, you literally like looking at it right now. I know when they got into SpaceX. And the nice part is, let's pretend you're accredited. Well, you are, but let's pretend that you're a retail investor who is accredited. I would argue going through this mechanism might have been a safer, better way for you to get exposure to SpaceX than going through an SPV lasagna with unknown markups and unknown who knows what's. Because here, one thing I can guarantee you is that if it's publicly traded, and by the way, it's traded on the app of the name on the fund, there's no way that they're holding forward contracts that are or something like that. Like there's no question where that is. So I would feel safer. It's just you get less allocation. That's all.
Yeah. And that's pretty much the point I was going to make. It's that, like you said, if you hold this for 10 years and you believe in the companies, they're going to go up. So even if these were overpriced when they were acquired at whatever series or anything else, the point is you're not going to invest in this and then flip it with a 200x return, in the next week or the next month. That's not going to happen. So I think just one other thing we've talked about, we'll start wrapping this up, Scott, but in the public markets, we've been talking a lot about Boxabl. So Boxabl went public through a SPAC recently. They most SPACs start trading at $10 a share. At one point 2 days ago, I think it was down under $4 a share. It closed at like $3.94, back up 20% today, very volatile. But wanted to share this real quick post from someone on LinkedIn who invested early on. So this is to show that even though if you invested in later stage, like in some of their more recent Reg A's when they were a $3 billion plus valuation, you're probably in the red right now. This person invested in 2020, $1,000. And, basically as of a couple days ago when the share price was $4.91, their share position was still 27,000. So they were up 28x. This just like double clicks on the fact of like, no matter if the company is great, if it's not great, if it's OpenAI or anything else, what matters is the value that you invest in. It could be a great company, it could be a bad company, anything else, whatever happens. But I think we wanted to show this just because, I want your reaction, Scott, but it's not just a bad story. It looks like the stock is down 50%, which it is. But if you got in on their 2020 round when it was probably, I could look it up, in the tens of millions of dollars and not $3 billion, it makes a huge difference later on down the road.
Oh man, I gotta tread lightly here. I am an owner of shares from, I think it was their first round, if it was on Republic. So I don't own a ton. Yeah, I don't own a ton. So let's look this up while I'm talking.
Good for you.
I don't own a ton of it, so it's not some crazy amount. And I got to double check which one it was, but I thought it was like the first one. If it was on Republic,
$42 million valuation if you invested. This is the round that closed in 2021, so probably opened in 2020. Yep. So they raised $3 million from about 1,000 investors at a $42 million valuation.
All right, what's the next round value?
It was $220 million.
All right, that's probably where I got in.
And then they jumped to $3 billion.
Republic's at $1 billion. Republic was at $3 billion. I did not do that one, but that's when I had him on the show. It was not the first one because I wasn't doing WeFunder at that time, so it's probably Start Engine. Either way, I should be like relatively fine. When you go back to the post, we've talked about this forever. I want to celebrate this so badly because it's the poster child for like ECF-to-Reg A+ to IPO, like and like. The weird little things about it, is the founders are kind of squirrely. The Elon Musk kind of Boxabl unit, he was living in one. Was he not? Was he? The plant that they built, are they delivering units? Are they not delivering? Like, there's so much uncertainty that the investors, like, this is the part of me that annoys me. And this isn't a worthless rant, I promise, and I'll keep it tight. Like, when I look at this, when I look at what you just showed me on Kingscrowd, I look at this thing and I go, God, these guys figured it out, that they were successful to raise on the concept of something big, raise a bunch of money at 40-something million. They don't have to pay for anything, so that number almost doesn't matter. They tried again at a quadruple the number, and they raise a bunch of money again, and it's like, holy shit, like we can just do whatever number we want. And then they jump in and they do it again, and it's like every year they just double the valuation of the previous raise and raise again and raise again. And every year they've got like a new little thing to push. It just makes me feel like they figured out the trick in crowdfunding and retail, and they just really exposed it and took advantage of it. And that's the part that is like, you could be the bell child for like how this works. But unfortunately, it kind of actually feels like you're the reason that we are concerned about the guardrails. And then you get to the part where, again, almost tied to my conversation with you a minute ago about Robinhood, when you invest is as important as what you invest and in who you invest. Like the movie Wall Street, being right or wrong on timing is still wrong. Like, it doesn't matter. Like, late or not is still wrong. And if you're the first one to invest in a company that 40-something million, which is crazy valuation, by the way, for anything, but if the company has big enough, potential, and it gets to to this milestone, then you could win. But everything else just gets a lot harder, and the more expensive it is before it's public, the harder it is. And I just look at this company and I think, that curve right there tells you the whole story.
So this is the revenue over time, right? And that says a lot. This is the most recent round.
Yeah. This is the part where it's like it's so much hype, so little reality. They hype-driven retail crowdfunding, and they crushed at that. Amazing marketers and not really amazing builders and salespeople. And that's not trying to take a stab at them. It's just what it is, man. And they go public, And I don't even know that in that LinkedIn post, was he able to clear that money out?
So that's one of the big things. It's the logistics of once they go public, you got to transfer it. So he says you have to go from the SPV transfer agent into your brokerage account. That's going to take a couple weeks. You got to fill out a DRS form. There's usually these transfer agents are set up for traditional, like old investors. It's not for, the digitally native usually.
So his $27,280 today is worth what? $17,000, and by the time he gets the paper out, $0?
Potentially. I mean, it was back up again 20% today, so it's almost $5 a share again. So it's still theoretically around the same thing today, but yeah.
There is a kudos here, right? Because I made fun of them. They did a thing they said they were going to do, and they did it. And I think a lot of credit needs to be given for that, because that is really, really hard 100%. To do. This is to get a company public is no joke. And one of the reasons when you evaluated them and when I invested in them, one of the reasons I did it was because of the team, because of the dad. The kid was a little kooky, but he was like, you could tell he's very smart and has very visionary, kind of view. And so for him, I thought really, I believed in that founding team as people who have done there before and could absolutely get it there. And they did. And so I think they deserve a lot of kudos. It's just along the way, the valuations and things. Like, it would have been so cool if they went IPO at $1 billion and not at whatever it was, and they weren't raising at $3 billion. And it just is a story that looks a little less, jacked up.
Well, we'll land this. I just want to show this one chart because you were just talking about this. Tons of IPOs go down after they go public. All about going public is about building the hype. I saw this chart, back before when we were talking about SpaceX. This is major IPOs in the last 15 years, the 1-year returns and max drawdowns versus the first closing day price. So you can already see SpaceX, 31% down, or 29%, kind of since the first closing price. Tons of these companies, Robinhood itself, everything else, 80% drawdowns from IPO price. So This doesn't mean Boxabl is not going to turn things around either, but I think the process of going public is all about building that hype. And then it's usually the insiders who have been locked up for 5, 10 plus years want to get liquid on their shares. And they don't care if it's at, a 50% discount, because to them, it's still a big markup. So, these are a lot of the dynamics we've been talking about, but Scott, we've been really diving in today. Good discussion. We'll wrap things up there, but thank you everyone. If you want more great insights like this, make sure you head over to kingscrowd.com. We got a free newsletter. You'll get weekly posts, data-driven posts, these podcasts, lots of other great content. See y'all back here next time. Thanks, Scott.